What's good? We back with another banger, and this one is covering crypto taxes explained, and how to make them lower. So naturally, you want to minimize your crypto taxes so you can keep more of your money and maximize your gains. To do this, first you need a basic understanding of how cryptocurrency gains are taxed. Then you can start thinking about ways to reduce or eliminate your tax bill. Hopefully the information and tips below will help you keep a lid on crypto taxes and let you get ahead financially. So, take this information to account. Remember to always do your own research, look more into these things. You just always want to make sure, you get as much information as possible to be able to make the best decision for yourself. So what are crypto taxes? Cryptocurrency is considered property for federal income tax purposes, and for the typical investor, the IRS treats it as a capital asset. As a result, crypto taxes are no different than the taxes you pay on any other gain realized on the sale or exchange of a capital asset. When you purchase a capital asset, be it stock, bond, house, widget, dogecoin, bitcoin, or other investment, you establish a basis equal to your cost to acquire it. When you sell it, you compare your sales proceeds to the basis to determine whether you have a capital loss or a capital gain. So just determine whether you made money or if you lost money. So if your proceeds exceed your basis, you have a capital gain. If reverse, you have a capital loss. So what are crypto taxes? So you'll also need to consider the time period for which you held the asset. Depending on how long you hold your cryptocurrency, your gains or losses will be considered short-term or long-term. That distinction will also play a big role in how much you have to pay in crypto taxes. So here's the definition for short-term capital gains and losses, which is when you buy and sell an asset within a 365-day period, you recognize a short-term capital gain or loss. Short-term gains are subject to the same tax rates you pay on ordinary income, such as wages, salaries, commissions, and other earned income. The IRS has 7 tax brackets for ordinary income, ranging from 10% to 37% in 2021. So 2 is the long-term capital gains and losses option or time period. Is if you buy an asset and sell it after a year, the difference between the sales price and your basis is long-term capital gains or loss. You'll usually pay less tax on a long-term gain than on a short-term gain because the rates are generally lower. Currently, there are 3 tax rates for long-term gains. For long-term capital gains: 0%, 15%, and 20%. The rate you pay depends on your income. So remember, it's always better, I won't say always, but in most cases it's better, especially with a stock or a crypto that you plan on holding longer term, to just keep it for over that year period if you don't want to pay that high tax on it, because a short-term tax will be all the way up to 37%. So let's say you made $100,000 on something, you could end up paying $37,000 in taxes. So remember to always set a little bit of money aside for tax payments as well. Maybe I recommend at least 15% of your gains to be set aside. 15, 30%. Some people say it's all up to you. Some people don't pay taxes on it at all because they believe the money is, basically is decentralized. Of course, there's always ways they could track it back to you eventually, but for the most part, some people keep their money off the grid or keep it in separate wallets, so it's a little harder to track. So they're not really worried about, gains, or paying the gains taxes. So if you're on certain apps like Robinhood, Webull, you got to remember they definitely report to the IRS. But certain other apps like maybe Trust Wallet and things like that, them not so much. So how to minimize crypto taxes. Now that you know a bit more about crypto taxes, which is really just another way of saying capital gains taxes, you will want a set of strategies to minimize how much you pay to the IRS. Here are some useful tips to reduce your tax bill. Hold until your short-term gains turn into long-term gains. As just noted, different capital gains rates will apply depending on how long you own cryptocurrency. If you want to lower your tax bill, hold your cryptocurrency long enough to turn your short-term gains into long-term gains. It may not be an easy task, but if you have the patience and fortitude to keep your crypto for at least a year before selling, then you'll likely pay a reduced tax rate on any capital gain. So another thing is to hold into your short-term gains, or learn another method to that is, or an example of it would be marry a single taxpayer earning $70,000 in wages for 2021. She also has $5,000 in capital gains from the sale of cryptocurrency. If the gain is short-term gain, she'll have $75,000 of ordinary income. After claiming the standard deduction, that leaves her with $62,450 of taxable income, which puts her in the 22% tax bracket and results in a tax bill of $9,488. However, if the gain is long-term gain, the $70,000 of ordinary income minus the standard deduction is still taxed in the 22% bracket, but the $5,000 of capital gain income is only taxed at 15%. That means an overall tax of $9,138 and a savings of $350. Now, that might not seem like much right now, y'all, but trust me, that will pay off big time over time, especially when you are making a lot bigger gains than 5,000. So the second way, or the second method, is offset capital gains with capital losses. Another strategy for lowering the taxes crypto investors must pay is to offset capital gains with capital losses. This works by subtracting losses on crypto assets that you sold during the year from taxable gains on cryptocurrencies or other investments that have appreciated in value. Though, be warned, you face limits when using this strategy. When you recognize investment losses, you first must offset losses of the same type. For example, short-term losses first reduce your short-term gains, while long-term losses lower your long-term gains. After that, if you have net losses of either type, you can use them to offset the other kind of capital gain. So, for example, if you have excess short-term losses, you can apply them against any remaining long-term capital gain. If you still have a net capital loss available, you can use it to lower your ordinary income. However, when pursuing this strategy, you can only use up to $3,000 of capital loss to lower your ordinary income in any given year. So remember, you can only use $3,000. You can only claim up to $3,000 of those total losses per year against those gains. So the remaining balance rolls forward to the following year to offset future gains or lower your ordinary income by up to $3,000. So 3, sell in a low income year. When waiting for your crypto gains to convert from short term to long term, you might also consider another timing element: choosing to sell in a low income year. Selling in a low income year can help with taxes on both short term and long term gains. If you have short-term gains which are taxed as ordinary income, you won't have as much other income added on that pushes you into a higher tax bracket. For example, if you sell short-term assets when you retire and are no longer collecting wages, your tax bracket could be based entirely on the income from your short-term gains. If you have long-term capital gains, a lower overall income for the year can mean a lower tax rate on those gains too. That's because the long-term capital gains rate that applies to you, either 0%, 15%, or 20%, is based on your taxable income. So if you have less taxable income, you're more likely to have a lower longer-term capital gain tax rate. So if you need to, just pause this. You could read over some of this as well. But also another way, so to finish that off, is also if you choose to retire early and have accumulated enough cash to fund your living expenses until you can withdraw funds from your retirement accounts, you might have little to no income during the year. If so, this is a perfect time to lock in long-term capital gains and possibly pay a 0% tax rate. So remember that. Connect those dots, y'all. So also reduce your taxable income. Closely related to selling your appreciated investments in a low income year, another tried and true tax minimization strategy involves lowering your taxable income. This means scouring the tax code for tax deductions and credits that can bring your taxable income down. For example, you can take care of expensive medical procedures, contribute to a traditional IRA or 401k plan, put money in a health savings account, or donate cash or property to charity. There are plenty of other tax deductions and credits that you may qualify for too. You might even want to ask a tax professional to help you uncover other tax breaks. So that's one thing I highly recommend, is getting a tax professional. This is my first year bringing the tax professional on to help with, determining, how I can save money, or, just what I would have to pay for everything. So trust me, that's not something you want to sleep on. Building your professional team, you should have a banker, a tax professional, a lawyer, you want to, and also, basically an investment manager, or an investment strategist, someone that's just a little bit ahead of you, who can, get, basically provide you with some insight. So I'm still working on finding, the right person that, fits my style. But, the lawyer's in place, the accountant, all these different things that you want to have, I'm setting all those things in place now, building my dream, basically my dream team, really, to, go to that next level, because you don't want to make all this money to have to give it all back. So, make sure you pay attention to this part. So also, 5, invest in crypto in a self-directed individual retirement account. Another strategy to minimize your crypto tax bill includes investing in a tax-deferred or tax-free self-directed individual retirement account, so a SDIRA. That way, you either pay taxes later when you conceivably have a lowerable tax income in retirement, or upfront when you contribute to your Roth SDIRA because you have expectations of higher taxes in retirement. So 6, gift the assets to a family member. Depending on your goals for using your wealth, you might consider another way of lowering your crypto tax bill, gifting your cryptocurrency to family members. The IRS allows you to gift up to $15,000 per year per person without tax consequences. While the basis in the cryptocurrency transfers to the new owner, the recipient might earn a low enough income where they won't pay taxes on the appreciated property when sold, or at the very least, less in taxes than you might have paid were you to sell the cryptocurrency yourself. So this strategy certainly plays into your broader estate planning goals and how you wish to transfer your wealth. That it also makes it something that you should first discuss with an estate planner to ensure that it fits your overall plan. So a lot of y'all that are part of the channel or inside my private stock market game group on Facebook, my private community with over 4,100 active investors right now, y'all will see me giving money to family members and different things like that. Now, of course, it's from the heart. I want to give, help out the family and everything like that. But I'm giving, I'm also aware that me giving away these thousands of dollars is also bringing down my the overall amount of money I'll have to pay in taxes. So why not help out family members, with this money? So let's continue. Here we got donate your appreciated cryptocurrency to charity. Similar to gifting appreciated crypto to a family member, you might also think about donating your cryptocurrency to charity. Not only will this result in no capital gains tax, it can also trigger a significant tax deduction you can claim on your tax return. When you donate an asset, you can claim the appreciated fair market value at the time of donation as a deduction against your taxable income. For example, if you own $50,000 worth of Bitcoin and choose to donate it to a charity you regularly support, you may be able to write this off as a charitable deduction on your return. Further, if the charitable organization qualifies as a tax-exempt 501c3 charity, it won't need to pay capital gains taxes when it sells the donated cryptocurrency later. So 8, move to a state with no income tax. So forgotten in this article until now, there's state level income taxes. Not surprisingly, your state has a vested interest in your investment gains as well. Fortunately, a number of tax-friendly states offer low or no income taxes. That means you might pay taxes at a federal level, but you won't owe much to your state's treasury. If you can, consider moving to a lower no income tax state to reduce or even wipe out taxes on all types of income. These savings can add up and help you keep more of your crypto earnings. So y'all know, for most of y'all know I moved to the state of Nevada, Las Vegas. You know what I'm saying? We don't have, a lot of those taxes here. Y'all got to connect the dots, I'm trying to save as much money as possible while making as much money as possible as well. So 9, bequeath it in your estate. So the final crypto tax minimization strategy on this list is to bequeath your crypto assets as part of your estate. When you pass away, the investment will receive a step up increase in basis to its fair market value at the time of your death. This way, your heirs will not need to pay taxes based on your original basis when they sell the cryptocurrency they inherited. However, because cryptocurrencies carry significant volatility depending on the virtual currencies you own, they could shoot up or down at a moment's notice. If this happens and the virtual currencies go to the moon, at least your heirs' tax bill won't be as large since they received the tokens with a stepped up basis. So that's it for, crypto taxes right now. Remember, this is just, quick information, that's gathered that I've used along my journey to learn from. I'm trying to just share it with y'all because it works for me. But remember, this is not financial or tax advice. So please get a professional to help you with this portion. I highly recommend it for this portion because they'll help you save a lot more money than you think. The money that you'll pay them is worth it in the end. Trust me. You don't want Uncle Sam coming after you, if you don't, know what you're doing. So that's it for this one. We out.